Thursday morning, and first rates any second will start kicking in on your screen. Any second now. Nifty flat with a negative bias. You got Sensex which is flat with a negative bias. But now you can see the market cutting out in favor of advances. Now you can see the market breadth, which is what we've been talking about, that it will start expanding in more in terms of small and mid cap stocks. You can see the profile of mid cap stocks. So just bear with me. I'm just going to load my screen. And there you go. You want to start with Zee. Post that Economic Times interview. Is the stock reacting? It should react. So Zee is up by about 2% right now. You got price action, which is rather constructive in Vodafone Idea in terms of volume action. Delivery, the block deal is gone, and post the block deal, I think the stock is up 5%. You got Indiabulls Housing Finance, which is trending up on very strong volumes, and you got Zomato, which is inching up by about 1%. But the real star, if I have to pick up anything, let me just see if there is something which I can pick up which is really out of the blue. Delivery, I think, is the only one which is coming on my screen. Actually, nothing apart from that which can be called like, oh my god, this is like
Delivery, of course, because of that block deal, but let's see what TCS is up to after them expanding the partnership with Nest. The deal potential, as we understand, could be about £1.5 billion over the next 10 to 18 years. HDFC Bank as well, SEBI has relaxed a rule with regards to warrant listing. So maybe these stocks get a little bit impacted. I want to see what Zee is up to, especially after Puneet Goenka's statements and comments to the Economic Times. Zee is seeing further traction. 183 is where that stock is right now. There's LTI Mindtree as well, by the way. They've launched Canvas.ai, which is an enterprise-ready generative AI platform, 0.5% higher on LTI Mindtree as we speak right now. Then, of course, there's Sansera. That block deal just happened. Look out for that. Shree Cement, wherein the IT surveys and searches are currently underway at their premises. That's going to be another stock in focus. All cargo as well, considering the LCL and FCL volumes have actually slipped on a year-on-year basis. So those are a couple of stocks which are going to be in focus as well. Then, of course, Shriram Finance, HDFC AMC, Timken, there are expected inflows because of the FTSE adjustment in these two stocks likely. And I want to see what Wipro as well is up to. Remember, the buyback opens today with minimum retail acceptance at 23%. Wipro has started off along expected lines, lower by about 0.5%. Glenmark Pharma also, they've received a warning letter for their Monroe facility. So look out for what that stock as well does in trade. But yeah, at an index level, it's an absolutely flat start. We weren't expecting anything different looking at the pre-open rates as well. Once again, the action is outside the index. Kunal, what trades could you punch in then?
Well, yeah, outside the index, and Tata Chemical is one stock which looks attractive. In fact, the stock has opened up mildly positive at 1,000 odd levels. That's a stock which I would look to trade in the open. Expect the stock to come out of a major consolidation lasting, which I think for the last 6 to 8 months.
Okay, since you talked about Tata Chemicals, let me just flag out Tata Steel as well. If you're seeing a technical adjustment on that one, remember it's going ex-dividend. That's the only reason it's showing a downtick for around 2 to 3%, but nothing else in terms of incremental news flow as far as Tata Steel is concerned. So that's the ex-dividend adjustment that you're seeing. Separately, BSE is the other stock which is seeing quite a bit of gain right now. It's up almost 3 to 4%. Overnight, remember, SEBI had issued a new circular to standardize the format of trading preferences. And that was with an aim to allow the clients with various options on the various exchanges to allow them to trade on those. And that's the reason this might mean a positive news coming in for BSE. So that stock has opened with a bit of a green tick. But Naresh, what are the trades that you are spotting?
For a change, me and Kunal are on the same one. It is Tata Chemicals. The stock is on verge of a breakout of the 1,020 mark. So looks like a breakout trade in the near term.
Well, all I can say is same pinch, guys. Tata Chemicals, it's interesting that Tata Chemical actually had cut soda ash prices, and post the price cut, which is the main component both for Tata Chemical and for GHCL, the stocks have gone higher. What I've learned in markets is that when a product price goes lower, profit goes lower. And here is a situation where stocks have gone higher after the product prices have gone lower. So this is liquidity or momentum, I don't know. All I'm saying is that the news is different than what the price action is indicating. Sanjay Mookim joins us. It's been a while we've not interacted with him. So nice to have him back on ET now. Sanjay, Good morning. Good to have you back. I was looking at your report, and your report has a very interesting take in terms of how you've divided the market: momentum, earnings, and valuations. So let's start with the first one, momentum, because I get a sense that more than anything else, there is momentum in the market. How would you start with the current market setup if you have to describe it under the headline momentum?
Well, morning. Good to be on. Look, I think India has benefited from a confluence of a whole bunch of positives in the last couple of months. Relative valuations for the market had gotten comfortable. I mean, they were not cheap, especially on a bottom-up stock level, but the premiums that we were trading at to the S&P or to EM, those premiums have come down significantly. At the same time, the macro condition for the economy was improving. The external account situation has improved dramatically, with the current account deficits diminishing almost completely, with growth surprising on the upside and inflation going down. And the last bit that helped us, to my mind, was this view from global investors of increasing concern on Chinese equities. With the China market flattening out and even actually falling, there was a shift in investor attention from North Asia to India. So this confluence, low valuation, improving macro, better relative position, has created that momentum in the market that you're talking about. Now, to my mind, all of the underperformance that we had earned in the middle of March or so, a lot of that has been covered, and any further momentum from here will depend entirely on what the global equity market does. So if the S&P continues to rally, we may also have further legs. But on the other flip side, if we do start to see correction, as most people expect, in global equities, then the India momentum will also probably fade away.
Great. Now, earning revisions. Earning revisions have happened. They've happened in case of consumer durables, autos, and IT. Sum total, where do you think FY24 is headed?
It's a very interesting question. Now, there are two parts to that story. If you look at the fourth quarter number, so most companies, or let's say majority of companies in the large cap or mid cap indices, have beat the bottom up expectations for the quarter recently. And this is not just because of higher margins. If you break down the beat, it has been also because of better top line delivery than people had expected. So that's why you get this tone, oh, things are getting better and companies are beating estimates and so on. But the challenge is that for FY24 and 25, the expectations were already so high that despite the beats that we've got in the quarter, most companies have seen flat to down EPS for FY24 and 25. You've seen earnings cuts despite strong 4Q numbers that have been delivered by companies. Consensus today for the Nifty pencils in about 18% growth for FY24. We did a scenario, paring down the growth expectations, taking a more reasonable sort of outlook. And my expectation is that we'll probably end up more like 11-12% and not 18%.
Right. Sanjay, what's actually stood out for me is the India model portfolio changes that you're making. And, I'm going to come to the ad weights a little later, but the cuts for Reliance, HDFC Bank, ICICI Bank, that's what's standing out for me.
Well, look, I will not comment on single stock names on TV. We are not allowed to do that. But from a model portfolio perspective, we continue to stay overweight financials, and we've added actually some PSU banks to our portfolio. And we also like on the margin non-banks, given the growth momentum that has been delivered recently. We like two-wheelers, staples, and we continue to be underweight IT. We keep making these portfolio changes on stocks here and then, but on core, we continue to remain overweight the financials.
Looking at an earlier note of yours, and you were talking about how El Nino could be a modest dampener in 2023. What do you think the probability of that is going to be, and what impact do you expect for particular specific sectors?
If you look at a 75-year history, and we have the data, then every time you get an El Nino, you do get lower than average rainfall in India. Now, I know the Met is talking about the Indian dipole condition as a compensatory factor. I'm not smart enough to understand that very well. But the historical evidence suggests that El Nino does lead to a deficiency in rainfall. And if you analyze that by state, the most of the lower rainfall actually happens in the drier northern sort of areas of the country, and the southern states tend to get away with lower cuts to rainfall averages. Okay. Historically, this has led to lower agricultural GDP, lower rice production, lower wheat production. All those correlations hold up. The only saving grace this time around, two things. One, irrigation proportion has gone up, so the sensitivity to rainfall is lower than it used to be in 1980. And secondly, India is now a surplus country on the basic staples, and therefore we shouldn't have shortfalls. We've done correlation analysis of rainfall with sector sales, and the only sector where rainfall tends to affect sales volumes is two-wheelers. It doesn't tend to matter too much for cement, four-wheelers, tractors, and so on. But for two-wheelers, we've historically seen an impact of lower rainfall on sector sales.
I want to go back to that point again, which is that in this market rally, and we understand that there are a lot of ETF flows which have come into India. ETF means that you are increasing your country allocation. It is not about individual stocks. But in this rally, the three horsemen of the market, if I may use the word, Reliance, HDFC Bank, and to some extent Infosys, they have not participated. It's not a stock specific comment, but the general view that flows have come back and the heavyweights have not participated.
Yes. Look, I have always argued that you can never paint a complete picture of the market just on basis of flows, because we don't really know the complete flow picture at any point in time. In fact, even the retail level activity data that we can track for the fourth quarter tells us that retail has returned to the market, or at least until March, retail was buying, but they were still only buying the large caps. And this data is available from company disclosure. Almost all of the new retail money went into the large cap stocks, not the mid caps and not the off benchmark stuff. Their problem is that the liquidity in these mid caps or the smaller names or the off benchmark names is so low that even if you get a marginal interest in these names, the stock prices can move significantly. So my suggestion is that this mid cap momentum is likely to be temporary, because like I said earlier, you've seen earnings cuts despite the strong quarter, and the entire rally that we've seen in mid caps has been on account of higher valuations. And you can take that phenomenon only to a certain degree. It is a beta sector in the market, and if we believe that the market's kind of topping out, at least in the short term, then mid caps could present to be a problem.
Question which in a sense we are discussing and debating with everyone is that the rally in US equities, especially in some of the US tech stocks, Nvidia, Microsoft, how can one really maximize by betting on this entire AI theme? As an Indian investor, what are the options for us in India that if the AI boom is coming, how can I make hay while the sun shines?
There are very few options in the immediate term, or at least if I rephrase it, there are not too many obvious candidates which will benefit in size from AI. It will happen over time. Indian companies will find ways to participate in this, will innovate and use AI, deliver use cases, whether it is from a consumer facing point of view or whether it is Indian IT companies becoming part of the implementation of AI eventually. At the moment, it's a bit too early to kind of call out a sector or stock beneficiary, but over time, I'm sure some Indian companies will find a way to participate in this.
Again, going to your portfolio, that is the most meaningful part which everybody wants to understand. Hero MotoCorp makes an addition. Dabur is added back. There is Bandhan Bank, which is right up there. NBFCs are making a comeback. Is there a play on rural stroke value which you're betting on for rest of the year? I mean, is that an underlying thread which you're connecting with, let's say, inclusion of a Hero MotoCorp or a Dabur or a Bandhan Bank?
The argument we've made, and we've been making for a couple of months now, is that the consumption outcomes for the bottom 80% of Indian households will improve. There are several data points that are encouraging to my mind. We've seen jobs data, the quarterly PLFS data that we get has closed all the gap that was created during the lockdown. Consumer confidence numbers are going up. Wages have stabilized. In fact, wages are positive in real terms in rural India. And we've seen corporate utilizations step back to where they were pre-pandemic as well. So to characterize all of this, the hole that was created in the Indian economy due to the lockdowns in the past has now largely been filled. I mean, there is still a debate of the pace of growth here on, but I'm out of the trouble that I was in the last sort of 2 years. And this means that the stresses I have seen on consumption, especially in an environment where prices are likely to be flat or down, those stresses go away. And therefore, some of the sector changes or allocations we make reflect the hope that we will see better outcomes on the lower income consumption.
Sanjay, I wanted to talk about the financial space because that seems to be the consensus buy. But within financial space itself, there are a lot of pockets, right from your mid-sized banks, your housing finance companies, microfinance, as well as the entire NBFC pocket. Which is the space that looks the most interesting to you?
Well, in terms of size, the large cap private sector banks still look great to us. There is a good growth value combination there and limited risk to earnings. So it's very unlikely that you will see significant earnings misses or downgrades or any of that for the next 6 odd quarters to my mind. And within the economy, if you do a scatter plot of valuation versus growth, the Indian large cap private banks stand out as being the most attractive to my mind. It is boring, I know, everybody talks about it, everybody agrees with me, but boring doesn't mean it is wrong. I think they will continue to compound steadily. So that remains our core view. We like insurance from a medium-term valuation, and the penetration argument remains secure. But in the short term, we've actually added some of the BFCs to our portfolio because the growth momentum is coming back. Now, this could end up being more beta and more cyclical. The growth could slow, or you could see credit cost coming in faster than in the banks. But given the momentum of growth at the moment, we've added some NBFCs to our model portfolio.
Sanjay, there is going to be an election cycle in next 1 year. And in India, the election cycle is always considered to be a binary event, considering the last 3 experience of election cycle, how markets have reacted. Has this entire kya lagta hai narrative started with institutional investors, especially at a global level? And do you see some reluctance coming ahead of the election cycle somewhere?
Not yet. If your question is a feedback on my conversations, the answer is not yet. It's a bit too soon. I expect this to start to happen in a couple of months from now. We've done some work previously and on the behavior of sectors in and around the general election. And empirical data suggests that sectors such as industrials and banks outperform 3 months into the election, and consumer kind of stocks tend to outperform 3 months after the election. It's a bit counterintuitive. People expect the consumption pack to do well before, but that's not been the case historically.
So if someone who's watching the show and say, Sanjay Mookim, I was bearish at the beginning of the year, but I liked your interview in ET Now with Anisha, Aisha and Nikunj, and I'm convinced that I want to buy India. Please give me ideas. I'm looking at 10-12% return in next 1 year. How would you address that client? It could be a real question. You may get this question right after this call.
Well, I'd say,
Sanjay.
look, if you
Trust
are
me,
positive on...
you may get this call after this interview.
No,
People
I'm
are
sure
watching
you
us.
do. Look, the way I answer is that it's easier to be positive on equities the longer time horizon you have, right? The more patience you can bring to the table, the greater the assurance of return. If you ask to make 5% returns in 6 months, the confidence I can present to you will be lower. If you ask for 12% compounding over a 3-5 year period, the confidence in that answer is much, much higher. So if you are patient, there is enough opportunity in equity markets. The more you trade, it's an odd thing to say for a broker, but the more you trade, the less the probability of making money, to my mind. India is still a great economy. It will still structurally continue to do well and better than many peers over the next several years. And any sort of long-term investor should consider corrections in Indian valuations as opportunities.
Sanjay, and just wanted to wrap up the conversation by getting your view on real estate as well, because that pocket is also seeing quite a bit of institutional investor interest now. But is it limited to the top strata? Is it across the board? Is there any particular geographical breakup that Street is liking there?
Well, our feedback is that this is a very secular trend and it is likely to sustain. So there was concern amongst investors, and rightly so, that the increase in mortgage rates would kill the nascent upcycle post-pandemic. We are seeing no signs of that at the moment. In fact, The recent increase in rentals across various parts of India should support capital values as well, and sales transactions remain robust. Additionally, many real estate, at least amongst the listed space, have cleaned up their balance sheets as well. So you have a great combination of good growth over time with decent balance sheets for companies, and we are overweight the real estate sector in our portfolio as well.
Sanjay, on that note, we'll let you go. Appreciate you joining us on the show and talking to us about the multiple facets of the market at this point of time. But talking about the facets of the market at this point of time, we're just 13 points shy of that life high level on the Nifty. We went very close. We were just 7 to 8 points away. From there, it's taking its own time to hit that mark of 18,887, but just about there. In terms of the specific stock action, BSE, as we highlighted, is up around 6%. Ether Industries has been in its good momentum, 5% higher today as well. And that entire ancillary of the financial space, case in point being 361 stock, ICICI Securities, Angel One, these are the stocks which are holding up with a gain of around 3 to 5%. JSW Energy was on editor's radar this morning. That stock is flying away in the trading session, 3% higher as far as that goes. On the losing side, just wanted to flag off InfoEdge, down 3%, and IDFC First Bank, wherein there has been a downgrade coming in from CLSA. They have cut the target, or they've actually increased the target but cut the rating to underperform versus buy earlier. So that stock is down about 2%. But time now to go across to the management coming in from MedPlus. Mr. Gangadi Madhukar Reddy is joining us on the show. He's the MD and CEO at MedPlus. Hi, Mr. Reddy. Thank you so much for making time and speaking with us. To begin with, I wanted to understand what's happening on the ground at this point of time. And there were a lot of headlines that came from one of your recent comments talking about how you're looking at selling 500 off-patent drugs at a discount of 50 to 80%. What's the strategy there? What will it do to your numbers?
Sure. See, we all know that India is largely a market in which more than 80% of the drugs sold are off patent anyway. So what that means is almost anyone who has got a manufacturing facility can do it. It just requires scale. So that is something which we have been building up for a very, very long time. Now we feel the right time. You know, the fact that we have close to 4,000 stores, we have a reach. We feel that we can actually get in and at least be one of the alternatives for customers to pick from. You know, when they come into our stores, we'll of course have all the brands, but if they so decide, they can actually take our offering at a 50 to 80% discount.
So, Mr. Reddy, is the game on increasing the market share of those drugs that you're pointing out? What's the, ultimate, expectation out of this move?
So this is something which only a person of scale and size can do. This gives us a huge advantage. This will allow us to actually, bring in customers from the small and medium size stores and all those other guys. We should, by being able to offer customers this large discount, 50 to 80% discount, be able to capture more of the market. It's as simple as that.
Just to, break it simply and correct me if my interpretation is wrong, if somebody walks up to your store and is requesting for a fever medicine, instead of giving Crocin, you would actually offer a paracetamol which would be non-branded. And that would be at a significant discount to its branded counterpart, right?
So the way we see it, it is Crocin is branded by, let's say, by GSK or whoever it is. There's an X drug which is branded by MedPlus. We don't say it is not branded at all. Just like someone else is branding it and putting his name, we also have a brand. We stand by this quality. It is not some X paracetamol 250 mg made by God knows who. It is made by us. We stand for the quality of the drug.
That's what I wanted to.
Given that we don't have the marketing costs, we don't have the other channel costs and everything else, we are able to pass on a lot of the savings to the customer. It's, in a sense, factory direct, and hence he can get the 50 to 80% discount, but not because it's not a brand. It is the MedPlus brand.
I understand the chemical salt and the chemical composition remains the same. It's the packaging which changes, and this is a off-patent CTC medicine. But there is going to be an inventory investment which you will have to do, because if you are looking at so many brands, so many stores, ultimately the inventory would be held by you. In case of brands, what we understand is that the inventory management is something which is the risk of a manufacturer, not the risk of the retailer. So won't you be adding a lot in terms of inventory management?
Not really significant. Given the fact that today, we actually buy medicines which cost, whose MRP is 100 rupees for around 68 rupees. These will probably end up buying anywhere from, 12 to 15 or even 20 rupees odd, depending on the average price would be probably be around that. So our overall inventory cost is not going to be very significant.
But Mr. Reddy, nonetheless, would it put any sort of pressure on your margins going forward? Because you had indicated that Q1 is going to be as it is soft in terms of margins. The store addition that you have had planned was expected to also drag the margins a bit. What's the outlook on margins then?
This is a pilot project in Hyderabad and rest of Telangana right now. In 3 months' time, we'll actually launch it across the country. I expect this actually to increase our top line and better our margins. This is not going to be a drag at all. This is actually going to be very good for the company.
So then what could be that margin profile that you're looking at, let's say, by end of the year?
A little difficult for me to comment right now, given that we have just piloted. We are seeing very good results out there, even in the first 3-4 days. But I can't really tell you that. See, I can tell you that, in the past, we have seen around 8 to 10% of private label. I see no reason why this one, with such a huge price advantage, should not actually exceed that going forward. But it'll take some time. And when I say 500 drugs, those account for every single therapy you can think of. It is not just the fever and this thing. It is also diabetes, hypertension, all the gliptins, almost everything out there. That number will end up actually going to around 700 to 800 drugs in the next 3 months or so. And that will account for nearly 80% of all the therapeutic needs of all our customers. So we expect this to definitely be in the range of, let's say, at least low double digits, at least, as a market share.
Are you saying that, look, you would have 80% of your current sales are going to be in these 500 drugs which you currently, 500 drugs which you would be eventually launching, and that is where you actually would have a significant margin benefit?
Oh, no. I didn't mean that. What I meant was, when we expand the range from 500 to 800, we will be in a position to cover 80% of the therapeutic needs of a customer. So as a customer, if someone walked in with, let's say, a list of 10 drugs, maybe 1 or 2, which could be, let's say, a biological like insulin or biological drug, or it could be a patented drug. Those 2, they will not be able to take something from us even if they wanted to. But otherwise, they could get 80% of their needs. We don't expect our sales to be anywhere close to that. As I said, we expect it to be maybe in the low single digits kind of stuff.
Right. Great to have you then on the show. Thank you so much, Mr. Reddy, for taking the time out and speaking with us today.
Thank you. Thank you for having me.
Okay, let's move on and let's just revisit what the market is up to. We're once again testing that all-time high on the Nifty. Let's see whether today is the day or not, because we are making feeble attempts, but we are coming flat as well. Very, very swiftly. So back at 18,887 for the futures and 18,864 for the Nifty, once again gone absolutely flat. But let's welcome now Mr. Bhanu Prakash Srivastav, Director, Other Units, Additional Charge, Chairman and MD at BEL, joining in on the show right now. Mr. Srivastav, great to have you on the show. Firstly, let's start off with something that has been in the news, Prime Minister Modi's US visit. Do you think post this visit, technology sharing with countries like US is going to improve? And what impact do you see of the visit specifically and especially on the defense sector?
PM is visiting US. We have a cooperation with the United States on various defense programs. And if you are aware that 2 announcements that collaboration with the GE and HAL on F414 engine for LCA. And another is regarding that MQ-9B, the drone systems. Apart from that, other cooperation in defense area will also be discussed. So definitely cooperation with USA will increase and we'll have a better business transactions in defense sectors with the US.
Oh, well, yes, that will definitely provide a fillip, the new discussion points with the US. But, it's been a good start for the year as it is for you. You have seen quite a few order inflows already. Nearly 30% of the annual guidance has already been achieved in the first 2 months. So then, is there a case to upgrade the order inflow guidance? It was earlier 20,000 crore rupees for the year.
As of now, we are maintaining 20,000 crore plus, but at the end of that 6 month of the half yearly, we will review again. Because what happens that it is a long run process for defense procurement, and what guidance we have given is that what are there in pipeline are likely to be in pipeline. If any major things comes up midway, then we'll review and we'll revise at that point of time, but not now. Because anything major comes, its cycle time itself will be around 1 year plus. So definitely new proposals coming are not likely to be fructifying in this financial year if it is a major procurement initiatives. Yes, small orders will continue in revenue or capital. That we have factored in 20,000 plus crores guidance.
Right. Mr. Srivastava, apart from the orders that you've already won, how many orders have already been declared as L1 and what would be the value of these orders and how confident are you of securing these?
See, 4,500 crores fuse orders we are L1, then around 5,000 plus crores order in shipyards where we are buyer nominated equipments and PNC is more or less at final stages. So if you see that around 9,000 crore plus we are already through at pricing level, definitely. Rest are under RFP stage, various stages which we have factored in our 20,000 crore plus guidance.
Sure, Mr. Srivastava, the reason we are asking this is that in the last many years, we have seen that BEL has managed to always surprise the street positively and beat the guidance. Is that going to be the case in FY24 as well?
Definitely, whatever guidance we have given, we are sticking to it and we are definitely going to meet all guidance, whatever we have given.
No, but the question is not only meeting the guidance that we are quite confident of, but what about beating the guidance? Any possibility, probability that you can leave us with?
See, we give the guidance based on the thorough analysis of all the aspects of the execution, business development, procurement and all. So, meeting or beating, even if we beat also, it will be marginal higher only. Or practically we meet it because we plan accordingly. So, our guidance are based on very extensive and thorough analysis of by our team. So, variance will not be very high.
You know, as we understand, improved semiconductor supplies was one of the key reasons for the strong FY23 performance that you had. Do you see the supply chain improving further?
We can't say that it is improving further. It is in the similar level what was there in 22-23. So challenges are there, but we are addressing those challenges.
Okay. So given the correction in commodity prices, any uptick that we can expect in margins, or you think raw material costs are still largely the same for you?
RM cost is all factored. See, whatever pricing and all variations or fluctuations are there. The way we sign the contract, like FE variation, most of the major contracts with MOD, it is taken care. And there are not very high fluctuations in the semiconductor prices. So I don't see any impact on the margins what we projected, at least for this financial year.
Mr. Srivastava, the company has also been trying to diversify a bit, look at non-defense sector. Could you talk to us about what's the client response been to the non-defense verticals?
Non-defense business, as of now in this year, it will be around 15 to 20% of our revenue, anywhere in between. But other area where we are diversifying or we are working on non-defense applications of the business, it's a long drawn process. Like earlier also I explained that diversifying in civil aviation business, we are diversifying into metro solution, which can be further extended to a requirement of railways. So our research teams are working. We have signed an MOU with Delhi Metro also, and then Airport Authority of India. But these are a long run process to give a very high level of business. The business potentials are there, but it's a long run process. So we maintain our ratio of defense to civilian between 80-20.
Given the government's focus on exports, what is your export target for FY24?
Last year we did $48 million. This year we are targeting around $90 million of exports. So it's very significant increase in exports. Margins are in the same range because exports also other countries they look for the competitive market. It's not like bare nominated. So they have an option to buy from other countries also. So we have to give a competitive price even in exports. Similarly, exports, if you see, it is divided into two parts. One is that direct supply, another is as a part of offset, so-called offset arrangements, where we give that high-tech components and subsystems to foreign OEMs who are further supplying the big equipments to India. So there also we have to be cost competitive. So if you see that margins in exports are in the similar range, whatever is in the domestic.
Okay, Mr. Srivastava, on that note, we let you go. Appreciate you joining us on the show. Thank you so much for that. But shifting focus and looking at one more, small company, and that's Gravita India. We're talking about this company because we had veteran investor Manish Chokhani joining us earlier, and he talked positively about that counter. First up, listen into what he had to say.
While we may think of 3, 4, 5 large themes, and within that you're, putting things in the right order. Nothing stops you. There's so many good businesses. We spoke last year about, I think, Gravita as an example. It's something we own, so I'm not suggesting you should buy it, but it's got the whole ESG tag ready. They're recycling the worst product, buying the worst thing that people want to dispose of. There's unlimited runway for capacity growth. You can go across multiple products over there. So it may not be part of some big thematic scheme of these 5 big macro trends. But individual stocks, there are just so many in India, and the entrepreneurship is so alive and kicking.
Naveen Sharma, Executive Director of Gravita India, joins us. Now, Naveen, you got endorsement of one of the smartest, Indian investor, Manish Bhai. He's invested in your company. That's something which he shared with us. So I'm going to take the liberty of perhaps asking you a very basic question. For those who don't know Gravita, and after hearing Manish Chokhani, want to know more about Gravita, what do you do? What is your business? How big is your business?
Thank you. We are into recycling business, primarily in non-ferrous metal recycling. You must have heard about lead metal, which is used to run the world entire energy storage system of the globe. More than 50% is stored in form of lead acid battery. Lead acid batteries required for your automobile, inverter battery, UPS battery, solar power backup, industrial backup. So we started our journey with recycling of lead acid battery in India, and we are operating in 6 countries in Africa, apart from that one in Sri Lanka. So altogether, we are having a capacity of this particular lead acid battery recycling to 50,000 tons per annum. Post that, we also entered into another product, which is aluminium, that also generated from automobile. So aluminum recycling is our second vertical. And third, we also entered into plastic recycling. And of late, we have entered into rubber recycling, which is tire. So we will say mostly the component which are generated from an automobile, the battery is generated in the life of an automobile at least 5 times. Tires too also 4 to 5 times. And aluminium, once the life cycle of an automobile gets finished. Similarly, batteries from other sector, industrial, home application, inverter, these are being disposed of, and we convert them after recycling in a raw material, which is again used by automobile battery manufacturers and other battery manufacturers. So this is a complete clear-cut example of sustainability and circular economy.
Okay, now why has your turnover gone up by almost 8 times in last 4 years? What have you done?
Because of capacity expansion, and this being an hazardous waste, the transboundary movement is restricted. So what we decided, the countries where this movement cannot happen, we put a facility at those locations itself, and we are making finished goods over there and exporting the finished lead to India and other part of the world. So because of our capacity expansion, this has gone up. Then second thing, this scrap, particularly post-consumer scrap or post-industry scrap, is also regulated by the government because of its nature. And post-GST and with the coming of EPR policies, there is a shift of recycling of this particular metal from informal to formal sector. So a small shift of 3 to 4% will generate huge volume. If I talk about India itself, we generate more than 1 million ton of battery scrap every year, particularly lead acid batteries, and not more than 45 to 50% is recycled in formal sector. So as soon as there are two policy interventions are going on, one was taxation, other one is Ministry of Environment and Forest brought some policy that how these products to be recycled, and all the manufacturers, producers of new batteries or importers are being told to fulfill EPR guidelines. The rules are under formations, so they have to fulfill whatever they sell. They have to get it either recycled or to buy EPR certificates. So I foresee that there is a huge scope as soon as these rules get implemented, and we foresee that lot of capacity expansion will take place, and there is a plenty growth in double digit in India itself.
Sharma, since all of your businesses are businesses of the future, right? Whether it be recycling of lead, aluminum, plastic, that's where the entire world is headed. Tell me, in the next 2 to 3 years, what part of your business is going to be your maximum revenue contributor?
We will be growing with our existing business with a CAGR of 25% in terms of volume, in terms of capacity, and we foresee all these businesses will grow together. Since we have highest capacity in lead acid battery, certainly the number in terms of percentage growth will be lower, but the aluminum base is, tire base is just we started begin in last 3-4 years. So the percentage terms, they will grow better, but all entire business will grow with the same pace of 25% CAGR.
25% CAGR for the next 3 to 4 years. But Mr. Sharma, this entire transition that's happening in the automobile industry to electric vehicles, how are you gearing up for that? Because your exposure to the lead, battery recycling, etc. will come down, right?
I will not say it will come down, because there are many other sectors which are growing even faster than that. And even in EV, there is a lead acid battery. One lead acid battery is already there, so it is not going to vanish. And if we talk about EV growth, there is a growth in Europe and US market, but Indian market, the both IC engine and EV will coexist, because our market is so huge. There are infrastructure challenge of charging the EV batteries. But when it comes, because the life of a EV battery is almost 6 to 7 years. The major sale which have started of EV in last FY. So we foresee the batteries which will be available for recycling will not before 27, 28. And there we are also hearing that this EV battery will have another life for other applications like power backup, etc. So, but however, still we are gearing up for this particular EV recycling also. We have decided to have our capacity in Mundra plant, and that we will see as soon as raw material is available, we will start entering into this business also.
You have a capex of 600 crore rupees plus by FY26, Mr. Sharma, as we understand. How are you looking to finance all of this? Would you be raising funds?
It will be mostly from internal accruals.
Sir, managing lead as a recycled product itself is going to have challenges in terms of pollution control. How are you managing that? Because lead per se, what I understand, my understanding of the entire supply chain is that it is a metal when processed or touched creates a lot of carbon footprint.
No, this is a myth. Lead as a metal, if you touch it, even you lick it, it is not going to harm you. It is when it converts into battery and battery loses its life, it converts into some chemical called lead sulfate, because there is sulfuric acid in the lead acid battery. When you cut the battery, you break the battery in an environment which is not an industrial or environment friendly, then certainly these can leach into the water bodies or in our land, soil. So the collection, storage, transportation, that itself causes 80% damage. That's where we are talking to the policymakers, and now government is ensuring that these should be collected intact without spilling acid at the site where dealer is being collected battery from the consumers. When it comes to plant, it is certainly done in an environment-friendly plant. We have an advantage over others because we are into project business also. We manufacture, take turnkey projects for complete recycling of lead-acid battery from crushing to refining, and we also supply plant and machinery to others. We have shipped more than 50 plants across the globe, and all our plants are being taken care by our own project division. So if recycling is done in environment-friendly manner, proper design, it is not harmful, and metal touch will nothing impact anyone.
Right. Mr. Sharma, just before we let you go, could you just help us with the guidance in terms of your EBITDA margins? Are they likely to be around 12 to 13% going forward? And also in terms of the export business, that's seeing quite a bit of rapid growth. What's the outlook?
Our export is almost 50% of our total volumes. That will continue to grow the same way. And when it comes to EBITDA margin, that is around range of 9 to 11%. And we remain optimistic to maintain it for another journey of 3 to 4 years.
Okay, Mr. Sharma, on that optimistic note, we'll let you go. Thank you so much for joining us today. For the markets, it doesn't seem like we're going to hit that life high level soon enough, because the market is again taking a bit of a dip. In fact, we have moved into the red as we speak. So that all-time high level is definitely seeing a lot of resistance before we hit that. In terms of stock-specific action, Max Financial is seeing quite a bit of breakout today, 5.5% higher. We did flag off ICICI Securities. That's up 5%. KEI Industries is doing quite well. Zee Entertainment, let's see what's that stock up to, because it was expected to open strongly and has maintained it. It's off the highest point of the trading session, but nonetheless watching out for that. And IDFC First Bank is down almost 4%. Nikunj, what about IDFC First Bank? Because a lot of experts have been talking about this stock fundamentally and positively, but now CLSA is downgrading it purely on the fact that it's run up considerably.
No, just because a stock has run up does not mean it cannot, it has to come down. Second, what is right and what is wrong in terms of a franchise, which is just about at a very strong J curve, I think is very difficult to understand. Now markets pricing in FY24, FY25, we don't know. The stock, for me, I see IDFC Bank as a franchise is at an inflection point. When the merger happened, they had to go through 2.5 years of painful write-down, and those painful write-down were a function of Vodafone. Those painful write-down were a function of some of the legacy loans they had. Their CASA was not great, the cost-to-income ratio was not great, and they were lacking technology. I think Vedi and his team has done a fantastic job in getting the franchise in order, and they are growing, and the NPAs are under control. The size what they are in right now, which is the balance sheet size, they are like a tiny toon. And for that balance sheet size to grow, I think it's not difficult. B, positive surprise. Are we in for more positive surprise from that franchise? The answer to that is yes. If you are more positive surprise from that franchise, then the scope for earning revision is on the upside and on the downside. I've always said that when the business is on a cusp of a positive earning surprise, the whole debate around valuation, I think, will just make it very, very myopic. So the stock could well correct, but is there a scope for re-rating after 2 quarters, or is there scope for positive surprise for FY25 numbers? I think there is. Look, it's gone from what, 40 rupees to 80 rupees. So temptation for anybody to book profit, I think, would be there, and it may bet slip if flows are not strong. But is this a stock where you say that I'm happy to own it for next 3 years, 4 years? Yes. There are not too many plays in the mid-cap banking space where you could see that kind of an visibility. Hardly any mid-tier banks right now give you that kind of an promise and that kind of an appeal. That's my limited point.
In fact, just adding to that, CLSA's latest note as well on IDFC First Bank, stating that they are downgrading it to an underperform from the previous buy, and the target price though has been now raised to 85 from the earlier 80, and I think it should be the other way around. Saying that it has been one of the best performers on a year-to-date basis, while they continue to like the bank's compelling story. They're saying that the valuations are getting a little bit steep over there. But let's shift focus. That's that on IDFC First Bank, which is clearly under pressure this morning. But here's Ajay Srivastav telling us, or rather before we go to the management of Chalet Hotels, here's Ajay Srivastav telling us why he likes this sector so much.
you're riding the best hotel wave ever the last 1 year has existed in this country. Number two, just like real estate, see the consolidation. Earlier, every uncle, auntie, and everybody wanted to put up a hotel. Now see what's happening everywhere. They're going to Taj, they're going to ITC, they're going to saying, listen, can we lease our hotel to you and you do the work at the point of time? Whether it is your home stay, whether it's a hotel or whether it's the economy hotel, they're all going to the big chains and saying, listen guys, take it over, give us some money back. So any industry dynamic like real estate has changed dramatically in the hotel sector. And I think that is where these guys are going to make a killing, because it doesn't make sense for anyone to have a standalone hotel today apart from the chains, the way the economics has worked out. And that's what's coming to the fore. Yes, they got competition, not from hotels. In market, the competition is coming from homestays. Most people are preferring homestays to hotels at this point of time, at least the upper end, the luxury class. And that is where they will get a competition from. But I think the big play is coming. All the existing capacity slowly in the system is getting leased to these companies. So if you look at next 5 years, the supply of hotels is going to diminish in my view, because there's no new construction at the end of the day for hotels. There are pockets of India which is totally don't have good quality hotels. So I think it's a great story. You'll get a chance to buy at lower prices, or most certainly, definitely you'll get a chance. Should you be out of the story? Or definitely not, because you don't know where the market goes. The party continues at this point of time.
Okay, so that's the comment coming in on hospitality sector. Definitely something that a lot of investors are watching out for positively. So let's discuss how the business momentum on ground has been, and who better than Mr. Sanjay Sethi, the MD and CEO at Chalet Hotels, to tell us all of that. Mr. Sethi, hi, good morning. Thank you so much for making time and speaking with us. To begin with, I wanted to understand what's been the demand momentum on the ground like. What are the occupancy levels that you are tracking at this point of time? How's been the average room rate at this point of time?
Good morning. The big story in hospitality is, I think, the rate movement, which has been very positive across India and in both segments, the leisure segment and the business travel segment. And I think it's held us well because the new rates seem to have got locked in at the benchmarks that have been created over the last few quarters. And they seem to be the base rate to work off for future quarters and years. So very positive story, as the previous speaker said, looking very bullish on hospitality in the country.
Point in time, demand and supply will match up. Is that 2 years away, 3 years away? How far is that?
Morning, Nikunj. I think we're at least 4 years away from demand and supply catching up. The reason being, hotels are brick and mortar business which take time to develop. And from announcing a hotel to actually opening it to guests can be anywhere between 4 to 7 years, depending on how efficient the organization is in developing the hotels. So we've got a fair length of runway, 4 years at least.
Specifically, what about business travel? Because that's where the large multiplier would kick in. What are the trends in business travel? Leisure travel, all of us know that it's hard to find a hotel, difficult to get a booking going. Even though we make calls, it's difficult because occupancies are great. But business travel is where we want to understand the trend.
Continues to be very strong. I think it's been strong for the last 3 quarters now, quarter after quarter. The cities that we are talking about as far as business travel is concerned have the same issue on the demand and supply side. Demand is outpacing supply by a significant margin, and supply is not easy to come by. In fact, even more difficult in large cities because real estate prices are through the roof. So there are natural barriers to entry that have been created in the big cities for new supply to come in. There are some projects underway in most cities, but they are only a fraction of what the current base supply is. So there's no concern in any of the, say, if you take the top 6, 7 cities in the country, really no concern on supply side growing at a pace which will affect occupancies or rates, at least for the next 4 years.
We understand that this year also a very strong advantage has come to the hotel industry because of G20. Now that really could be a 1-year phenomenon. A, how much has that impacted your business? And B, next year when the G20 push is not going to be there, will anything change meaningfully?
So Nikunj, I think the G20 is spread thin across the country. So I don't think it's impacting business of any hotel company of any size materially right now. But what it has done is that wherever it goes, irrespective of the hotel that the event happens in, it creates a compression in the market. I was in Goa just now, till day for yesterday, for the G20 meet on tourism. And the cities still had rooms, but the whole hotel that I was staying in was occupied, and therefore it created compression, and thereby a lot of the business got pushed out to other hotels. And that's happening in the city hotels also. So if an event happens, say in Mumbai, and a hotel is occupied, the regular business of that hotel gets displaced to other hotels and fills up the city. That's one. Second, the more important thing is, I think G20 is a one-year phenomena as far as current business is concerned. But my belief is that the spin-off effect of G20 is going to be far further reaching than just 1 year, because the people who are coming into India are establishing relationships, setting up businesses or expanding businesses, and this will continue to benefit India for years to come. So therefore, in my mind, I'm seeing G20 as a positive for a long time to come, not just this year.
Cricket World Cup, will that be an upside? Is that something which could get captured in the second half of this year, the fact that Cricket World Cup is due?
So Cricket World Cup is again a month-long event. It will create compression when the matches happen. Clearly, Ahmedabad is going to benefit. We've heard that the India-Pak match is likely to happen there. And we'll see probably, I think, one of the semis or the finals happening there too. The schedule isn't out. But yes, again, it's spread thin. It'll create compression for those few days in the market. But, it's a one-off event. We don't get too excited about one-off benefits that you get. It's the long-term benefit that we're going to look at. And I think G20 has potentially a long-term benefit.
Just wanted to understand what happens to ARR. Anisha was chatting with Navjeet of Hilton, right, at the Conrad Pune just last week. And, he said something which really, sort of stuck out for all of us. He said that forget it, ARRs are not even going to come back to those 2019 levels. Is that the reality, Sanjay, that we'll all have to live with?
There seems to be a comparison of recent past as far as average room rates are concerned in the industry. And I think you got to look a little wider than that. And Navjeet is right. Our ARRs were underplayed for several years. And today we are sort of catching up to the natural average room rates of for the industry in India. We're still far away from the other gateway cities in the world. We are still, I think the big cities are still 3x India. But even if you don't compare to the New Yorks and the Parises of the world, you can't be discounted by 50% on Singapore. And we are currently discounted by 50% of Singapore. Will we get to Singapore rate? I don't think so. But will we close the gap? Absolutely. So in my view, we are looking at least low double-digit rate growths year on year for the next 2 years, and then probably stabilize to inflationary growth after that.
A lot of your peers are talking about experimenting with new formats. Taj has moved into Cumin. They've moved into Amar Trail. ITC is also experimenting with a lot of things. Is Chalet also planning to do something which is strikingly different, putting technology and outdoor experiences together?
So Chalet's got its own diversification plan, which is very different than some of the other hotel companies, right? To begin with, we were not an hotel operating company. We are now getting into more and more operations as we sign more franchise contracts, and some hotels we run under their own respective brands. Our diversification is more on the asset class side, Nikunj, and I think that's really helped us through the pandemic and is likely to help us going forward very strongly. Just to share some numbers, we are currently 500,000 square foot of office space on rent. We're developing another 2.5 million square foot. That will still be only a small fraction of the total business, but it will give us a significant amount of stability. 2 million out of the 3 million square foot is going to be in the healthy rental markets of Mumbai, and 1 million in Bangalore. The Bangalore 1 million is almost ready. Around 800,000 Mumbai is almost ready. And the balance 800,000 square foot that we've developed will start soon and get ready in about 2 to 2.5 years' time. All in all, 3 million square foot. And it's an easy math. The rentals in Mumbai in that region are about 125 odd rupees. Bangalore is about 62 rupees. Flow through from both the cities is going to be in the 90-92% mark. So clearly, healthy EBITDAs flowing through into the Chalet balance sheet on account of these office assets, which will continue to support the business through its cyclicality as and when that happens.
And Mr. Sethi, before we let you go, just a quick word on the occupancy level that we started the conversation with. I understand it's trending between 70 to 80% for the industry. Is that likely to be the case for the next, let's say, 12 to 24 months at least?
So, you'll have monthly and quarterly variations that happen, which are natural variations across the year, right? Quarter one and quarter two in our financial year is always typically lower than the other quarters, especially for city hotels. And then it sort of ramps up very rapidly in quarter three, quarter four. Overall, annually, yes, I think everyone's going to be in that 70 to 80% mark. Rates have grown tremendously, so the RevPAR will be very, very strong. We expect RevPARs to be in the range across the industry at least 20% higher than what it was last year. And I think that's where the industry is likely to be positioned at for this year.
Okay, thank you, Mr. Sethi, for joining us and talking to us about the fundamentals of the hospitality industry, which look quite promising at the moment. But what does not look very promising is the market texture at this point of time, because the mid-cap and the small-cap index are actually on the back foot today, so not seeing a lot of momentum from the broader markets. That's been the case for the last many weeks now. But it's Nifty, which is flat around 18,860, and the Bank Nifty is actually outperforming a bit, if I can call it that. A gain of almost 50 points coming in. In terms of the big gainers, Adani Enterprises, M&M, Eicher Motors are stealing the show. And on the losing side, Infosys is down almost 1.5%. The global brokerage that had actually downgraded Infosys, so we're tracking that. But on that note, slipping into a very short break.